Welcome to another episode of the Australian Retirement Podcast. Today, we're going to do a deep dive into a very specific investment issue or asset class, which is alternative investing. I'm happily joined by good friend and prior Olympic rower, Christian Ryan, who, among other things, has been a financial advisor, an Olympian at various points, but also an alternative asset manager. So welcome, Christian.
Thanks, Drew. Thank you. Good to have a chat about these issues, which is good.
I feel like it couldn't be more topical. So this will be it's probably a few weeks ago now when people listen to this that, Trump turned up and put some pressure and a bit of a rocket under markets in both a positive and negative way. So I think it's a perfect time to go deeper into something like alternatives. And I find it really useful given your experience, and maybe we could start on that, your experience coming into financial services investments, that you actually started as a financial advisor before kind of moving into this area. It'd be good to understand how that shaped your approach to investing and your kind of understanding of alternatives.
Yeah, well, actually, before I got into financial advising, I was actually in accounting, tax, and finance. So, And through that, working for a major Australian bank, you actually got exposure to good Australian small, medium-sized businesses trying to do, good things, lending money and growing profits. And a lot of that lens has sort of stayed with me for quite some time because there's great many Australian businesses that you just don't know about, or assets or opportunities or private assets. We only hear about your BHPs and your Westpacs and your Apples and your Googles and all that sort of stuff. But there's thousands and thousands of companies, not only in Australia, around the world that that you can invest in. So I think it's a very topical issue with what's going on, and just really, I think for investors to understand the difference between the two, and not to be, I think to have a good understanding, but not to be scared about it. I think, and the more that they can understand, and people such as myself can actually help educate that, then I think hopefully people will keep feeling more comfortable to invest in these sort of alternative investments that are available.
Yeah, that's a perfect start. And maybe it's worth defining for the audience what alternative investments are. And you've probably got a different, from a financial advisor perspective, you've probably got a high level view. And then from an asset manager perspective, you're looking at your smaller micro asset class within there. How do you define alternatives in your financial planning business?
Look, for me or for us, and I'd say that for me or for our wealth business, it's really probably assets or both from a growth perspective and an income perspective that I would say are non-liquid as the primary difference, or limited liquidity between everything else. I would say that's the number one really difference between the two. If you compare a private equity opportunity versus a listed company, ultimately they're two companies generating revenue, generating profits. Simply one you can trade shares in and one you can't, or have a limited capacity from time to time to trade those investments. So for mine, that is the number one criteria, and that's the same in fixed interest. And there's been a big topic over the last months around private credit. What does it actually mean? How do you invest it, and so forth? And ultimately, at the end of the day, with private credit, you're lending money to someone. Banks lend money to people. There's just liquidity is the main difference, between the two, and that's how we consider alternative assets. We don't invest in a whole range of different alternatives. There's left, right, and center. There's all different types of terminologies, but for us, I think the best approach is to keep your investments simple, particularly in alternatives. And for us, that usually lends itself to sticking to real estate, private equity, private credit, and probably infrastructure as the four key, real assets, if you like, real businesses, real assets that people can see, touch, feel, and understand as the four key areas that we consider alternative.
Yeah, I mean, we've got, maybe I'll put in the show notes as well, a periodic table of alternatives, and it's probably bigger than non-alternative, like traditional investments.
Yeah.
So traditional investments, we're talking listed shares, your BHPs, your Apples, government bonds, corporate bonds issued by groups like Woolworths. And then when we talk about, I think I'd agree as well, you can go into things like venture capital, you can go into special situations, you can go into all this realm of things, but ultimately what you're looking for is, investments, whether that's debt or equity, into private companies.
That's right.
And it seems like the big reason for that is that all the stats come out all the time. It's something like over 90% of companies that operate within his size and scale in the world aren't listed on a share market. So if you're only investing in listed share markets, you're not actually getting a true exposure to probably the companies that are driving the economy. I think you touched on income and growth. Are they the main, the key parts of any return? Is that what first drew you to alternatives for your clients? Because I know your business, which is called Fincap, be good to understand a little bit more about that. Is that what drove you to more demand for those type of assets?
Yes, I think people, I think there's a level within each person's portfolio that ultimately you're probably not likely to touch from a capital perspective.
Yeah.
Could be 5%, could be 10, could be 20, whatever you think is appropriate. So therefore, what attracted me to this when I was seeing these businesses, particularly through my financing and early stage of being involved in a family office and financial advising, and was that these great companies were paying out really good cash flows, good dividends, and ultimately good growth outcomes, for investors. But you just weren't getting the volatility at the end of the day of daily pricing. Now, yes, there are regular reviews about understanding value, but you could have a lot more hands-on, if you like, and certainly what Fincap does is to be a lot more hands-on in terms of the investments and therefore the outcome. At the end of the day, when you're investing in shares, like listed market, you buy a small percentage of, the overall company. And typically the drivers of those outcomes is management and markets and their growth. And you really don't have any say to some extent as to, how well or not well that company's going to go. Whereas in private assets, if you collectively get together with some other investors and co-invest and do all those things, you can have a really good influence over the outcomes and therefore have a more of a broader influence over the outcomes of the returns that you get without, I suppose, the noise, the interference, the day-to-day volatility of your share price, which can really drive, behaviors that you don't really want. So
is that a big part about filling those gaps within portfolios? Like, do you see risks in a traditional bond share market oriented portfolio that retirees aren't kind of aware of, or not, retirees or even financial advisors in general aren't really addressing?
Yes, I do. I think the biggest, say, if I look at Australia, just focus on Australia for that discussion point. I would say a big part of it is that ETFs in the world are owning more and more of the exchanges. So capital flows are going to get more highly influenced just by flow of capital, not necessarily so much about the profitability of the business or the opportunity and then driving, the price and the appreciation. So I think people are missing out. Like at the end of the day, there's, I think, a couple of thousand listed, securities in Australia. And there's thousands and thousands of great businesses and now there's increased number of money managers and so forth looking to, get hold of those opportunities. We're talking about over the next 10 to 15 years, we're talking about, and I'm sure many of your listeners on the audience here, there's plenty of 60, 65-year-old, 70-year-old people that want to retire. They need their business to succession plan out to someone. A lot of those are real issues where there's value that's being created by these groups, and they just sometimes need new capital and need a new pathway with younger people to drive that group. So, the growth opportunities, I think, in general, really are in the private world. Yes, there are good opportunities, in general with Australian listed stock, but really, you've got so many more options that you can go and find and be part of and invest in that areas. And I think the main reason I think people aren't maybe necessarily up the curve on it, but they're probably small business, medium-sized business owners anyway, is they just not exposed to it nor understand it, but probably would feel comfortable. Oh, okay, well, I can invest in a cleaning business or a renewable battery business or an education business. There's things that they understand.
And what do you think about, there's this, Buffett, Munger always quoted as saying, don't invest in anything you don't understand. What do you think about that?
100%. I think in the alternative space, if I put my Fincap hat on, I mean, we love to invest in business that are simple and easy to understand, hopefully generating good cash flow and are great Australian businesses. That's it. And if you can't answer, what's the old saying? If you can't explain it to your grandmother in 2 minutes, then it's probably something you probably shouldn't invest in. When structures and deals and things just get too complicated, you should just, unless you're highly sophisticated and this is the thing you do, you should just sort of walk away and look at something else, because something else will come along, because there's lots of options that are available.
Private equity is actually usually more simple, and we'll get into maybe some of the examples of the investments you're looking at, but it's usually easier to explain an investment in a private company as opposed to an investment into a multi-asset fixed income strategy that's in RMB, or all these acronyms start to come in. So.
Correct. Yeah. Look, I've been dealing with private clients for 25 years, and at the end of the day, yes, we probably get guilty of using too many terminologies and trying to make it more complicated. And I think you have to be the exact reverse in alternatives and private assets. It's got to be simple, clean, as easy to understand as possible. And I think you then have a greater chance of understanding what you're investing in and getting a good outcome for that.
So we've narrowed it down to kind of private market assets, illiquidity, and the role of kind of income and growth. Do you have there's articles all the time, and a lot of the alternative asset managers talk about it, that institutional investors have as much as 40 to 50% of their portfolios in alternatives, and probably some of the big investment banking type advisors. Do you have like a starting point you have for clients, or do you think you see it as being more specific to each person's objective?
I think at the moment, I think you would have to say, just generally on availability, private capital opportunities generally been available mainly in institutions, and now it's coming down to the scale. And I think to invest in private assets, you still got to probably have a minimum level of money in your portfolio. But if you want to invest in it, I'd certainly suggest you sort of start. Some are going up to 40 and 50% of their assets, but as a general rule, and obviously you need to consider your own personal circumstances, starting with 5, maybe 10% gives you a foot in something to test, to understand and invest in things that you feel comfortable with.
And how do you work with clients that, initially kind of afraid of the illiquidity? I know I have so many conversations and the YouTube comments come up as well. When you say people are going to live for 30, 35 years in retirement, that's an easy story to justify having some illiquidity, but it's very difficult for people to kind of understand that when you're putting it to them initially.
There's probably two ways that you look at it. Yes, that's probably one. Two, if you're going to be a financial boffin, you can quite easily do your modelling, which will clearly outline if you're drawing down on X and your return is Y, there'll be X amount that you just won't touch for X amount of years. I think to go with liquidity hand in hand eventually will be transparency around, a bit more information flow of what's happening with these companies. The benefit of private companies is you get to, keep just doing what you need to do and update, periodically to investors. I think as the world and compliance and regs catch up, even in a private company, there'll be better minimum standards that you'll have to probably comply, which will give more confidence to investors investing in this area.
And is a big part, so we talked about income, there's income generation, obviously the private credit, so private lending, and there's growth potential. Is in terms of the benefits to a portfolio, how does it help during times like the last 3 weeks in having an allocation to alternatives?
Well, I think, especially from an income point of view, there are the two ways we look at income is either private credit, which is what you spoke about, or two, we actually really like operating real estate assets, which deliver similar levels of cash flow. So what operating real estate means is businesses and the assets are combined almost together. I'll give an example. One that we invest in is we own school camps for kids, and so the land is really derived from the earnings or the operations, the business. They sort of fit hand in glove with each other. And that gives out, 10% cash flow, plus there's some, some upside in the capital growth, that to deliver on. But in times like now, the value's not changed. It's really, the value's not changed. You've got this steady stream of monthly or quarterly income that just keeps coming back. And if you look up in 1 or 2 or 3 or 5 years' time, It's like a house, isn't it? Like you don't sit there every day and think, oh, have I changed $1,000 or have I down $1,000? You look up probably in 5 years' time or 10 years' time when you decide to sell your house. They go, oh, well, I bought it at that and that's what it's worth. Well, it's really private investing is sort of no real different. It's just, I think some of those improvements will gradually get better to give people more confidence that they can allocate 5 or 10 or 15%.
That's kind of forced patience too, isn't it?
Like forced patience. Yeah.
And do you agree? I mean, not agree. Have you not? Do you agree? Have you seen? There's stats that say that there's something like private markets have returned about 3 to 5% more than public markets over the very, very, very long term. Is that something you see and expect to continue?
Yeah, you've got to. If you're looking at private assets, you've got to have a higher return profile or premium for liquidity that you're taking on. I suspect in the future, though, in the next number of years, I don't know what that is technology will make it more available that if you want to get out of something, if that's your choice, there will be a tradable market, at some point you can say, hey, sell that and buy that and see you later. Now that, whether it's at a discount or a premium to what it's worth, well, you just make a choice. I think that's not available really today, but I certainly have seen that being more. So ultimately, I could see a world where there's almost the ASX of private assets that people can trade and be in and out of it if they want to.
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. That's all available in the link in your YouTube description. Let's get back to the show.
And there seem to, you've kind of alluded to it, which is a heap of new options and a heap of new access coming to this kind of sector. Mm-hmm. Can you talk through how the structures, the way you invest into these assets? And then there's a few listed options. We don't have to talk about any specifics, so you can be open on those. And there's obviously some are suited for different investors in different markets. What do you see and what do you prefer as an exposure to get to invest into these assets? And I'm sure you don't just investing outside Fincap. I'm sure you've got other private equity and private market.
Yep. Oh, look, even though Fincap is focused just on, private assets, good, small to medium-sized businesses and operating real estate, it's only one market segment of all the different opportunities. I'd say where people have certainly invested more recently, which we're comfortable with, is private credit. And what I like about, say, the listed versions, let's say, so there's Metrics, there's MA Australia as a couple of names, Qualitas, KKR, like they're providing underneath the hood. Ultimately, there's a bunch of private assets that you get to own. And the great thing is that they can just keep investing that capital without the worry of draw down, sell down, buy up, buy down. They manage it. Obviously, the listed structure, provided by theirs allows people to trade in and out without disturbing the underlying assets. If we think back to, call it GFC days, where a lot of these mortgage funds and private assets sort of fell apart, is they're providing this high liquidity to the assets, but there wasn't matched with the profile, that they had with the assets themselves. So when people wanted to sell down, well, they had to sell down the assets at the same time.
At the worst possible time.
At the worst possible time. So I quite like the structure of that, right? I think that works quite well, particularly for people that want to allocate a small amount, or amounts to the market. But they have to also understand that in markets like now, when it gets highly volatile, some people just run to the hills and go, I need liquidity, so I'm going to sell down the most liquid thing I can, which some of these are. But I would reiterate that when you invest in these things, people and it's been made clear to me through all the recent articles and information, there's still an education process actually understanding what do these investments actually invest and do. Do you understand it enough? And do you feel comfortable that that's what I'm expecting? So, for example, if at times, not everyone's perfect, and there probably will be some bad loans that go bad, But what do you do? In a strategy, I go, do I accept the manager has the resources to actually take over the loan and try and hold on to it and do something about it and get my money back? Yeah. Or do I do what the traditional banks used to do and say, well, I'll just take 50 cents in the dollar or 20 cents in the dollar and wipe out all that capital, from the return. So very, very different beasts.
Yeah, I think it's probably a good time to get it deeper into the types of private markets and alternatives you work in. So I know there's probably, if you talk about private equity, there's still this misconception I'd say out there that it's go into a business, cut all the costs out, sack everyone, sell everything, and sell it for more in 5 years. Maya, all these kind of examples of that happening. But there's a big part of private markets that's actually about supporting growth. And there's also, I think, private credit. A part of that, a lot in Australia is property, not necessarily company lending. But it seems like a big part of that is this assumption that if you can't get a loan from a bank, you're a bad company. So can you talk more about some of the businesses you're investing into and kind of looking at? And I think you alluded to it before, which is some real asset backing, which helps provide some support as well.
Yeah, look, I think we are, and I think people should think about it, keep it, I'll read it again, just keep it really simple. If you're in private credit, you lend money to someone. The people that might pay more because they might have a shorter time frame, they might have a higher growth profile. And to be honest, most of the time it's much easier dealing with non-bank lenders versus, the banks themselves. The banks now are just, if you don't fit that box, then don't worry. They
only lend to rich people now.
No. And two, but the good thing about that, if you know you're in that box, you're going to get the cheapest cost of funding, right? Yeah. But people might be just slightly out the box, and they might, there's so many different options that are available. And then if you go to the offshore markets, I think like 80% of the market's offshore, driven by non-bank and other bank lenders. Just traditionally, we just, we're just used to the banks.
Yeah.
Private capital, equity, I think it's not like it. People used to think it's like it's just owning good assets, whether that's like owning an airport or owning a building, or just I own that franchise. I mean, every good business on the ASX started somewhere as a private company at some point. Yeah. And it's grown and eventually listed. So there's just, we typically seem to fit, we like where I think is the best options is in this, what we call middle market type of area where businesses are generating good cash flows, but it's the big PE funds want to buy big assets and big toll roads and big infrastructure, and they want to spend 100 million, 200 million, 500 million, $1 billion. But there's a lot of great business which we target where you might only spend 5 or 10 or 15 or 20 million and help them grow to get it up, to the next level. And there's so many different options. It's just, again, just got to keep it simple,
And how important is, I'm sure that's where a lot of your growth has been, in stress testing, understanding, and then finding those ideas? Like, it's easy for an advisor. We open our email accounts and we'll have 47 different people selling us something in any given day. How do you suggest listeners, but also how do you find assets and then do the due diligence, and what can they do when looking at your approach or your investments or alternatives as well?
Alternatives. Oh, look, I think at the end of the day in alternatives and particularly private assets, it's the biggest one if you get it right, and if you get it wrong, is the people.
Yeah.
You all other things you do, financial due diligence, legal, and you ask as many questions and you do all your homework as much as you can. But at the end of the day, the outcomes from those private assets is primarily driven and more reliant on the people. Yes, ASX listed companies rely on people and so forth, but at the end of the day, if someone walks away or, the share price fall a little bit, but they've got a corporatized large structure that they can weather, someone leaving and someone going. But in a lot of these businesses where you get the high uplifting value, you want the founders or you want the key people incentivize the really good people to understand what they're doing. If you get it wrong, which, we've got it wrong before, it is, it I wouldn't say it hurts, just for so much more intensity to get it right and work out what you got to do, for.
And what do you see as the most common misconceptions? So you do presentations, lunches with prospective investors. What are the most common questions you get? I'd probably go to a few, but I reckon you'll answer them anyway. What should people ask? What shouldn't people be asking, but what do they ask?
What do they ask? It's actually quite broad. I mean, at the end of the day, it comes down to, again, how, like, if I'm going to invest in this thing, how long should I expect my money to be not accessible?
Yeah.
Like that's a big one. If I need to get out, what happens? Well, you have to create a market for it, and sometimes there isn't. You just gotta, you gotta wait. Who are the people involved? Is a big one. What sort of returns? They're all very similar questions that should be asked as if you're investing in, again, the stock market. At the end of the day, they are two companies could be doing exactly the same thing. One's just got ASX listed, it's got liquidity. The other one doesn't. So those broad questions you should ask. And again, if you don't understand it, or the people that you're backing, whether it's an investment manager, how much influence and control, without strangleholding, founders and partners, how much control, how much sort of influence or contribution can they have to that company? We typically think if you're only a 2% or a 5% shareholder, you're there for the ride.
Yeah, you
could have it. We think it's important in these mid-market assets, you want to be owning 15, 20, 25, 30, 40 sort of percent, so you can have a say, you can sit on the board, you can represent your investors, that you're making sure that that you're acting in their interests. And two, from an investment manager point of view, you're putting your own money in the same deal as them, so you're completely aligned to make sure the outcomes are getting delivered.
Yeah, perfect. And I think just before we wrap up, it's probably worth telling us more about Fincap. I'd say it's almost, is it 5-7 years you've been around now?
Oh, only four.
Only four. Yeah,
yep.
Going through the deals and growing.
Growing. It's been, we started right, and then 2023 and even parts of 24 were pretty rough. Just people putting their money when you could get 5% term deposits.
Weren't,
weren't interested. And over the last 12 to 18 months, people have become more interested. Certainly private credit, has got going first. I think the next leg is private equity, and different strategies that I think venture capital, is on the nose, and that's something that we don't do. We just do traditional sort of, like, we want to own good Aussie businesses that we'd like to grow at a really healthy level. And for some assets, especially operating real estate assets where you've got the land and plus the business on, we want to provide really good cash flow, to investors, so you can get some capital growth as well as high levels equivalent to, to private capital, also private credit. So they're the core areas. We're creating a platform where there's heaps and heaps of activity in this small, I'll call it mid-market space, because there's a whole bunch that want to retire. There's a lot of young people looking for alternative ways to, get involved with businesses. There's the gig economy. People are discovering and opening up to more opportunities. So it's a pretty exciting sort of place again, but you still don't be just, I think, in COVID, there's a bit of money just flying around, particularly to VC stuff. People want just good businesses that are providing good margin, good profit. And if you can find them and help them grow, and exit at some point, you should make good money.
And not moonshots anymore.
No, I don't. I just don't. I just doesn't work for me. Might work for others. If you're doing a 1 in 100 shot or 1 in 50 punt, my view is buy businesses at not very expensive valuations, good profit, good margin, and help them grow. That's a less risky way. Maybe your IRR returns might be slightly lower, but I think it's a more steadier, good approach, to private capital equity opportunities.
And you've had some kind of interesting assets as well. What would be your favourite that you've done so far? It doesn't have to have finished yet. Like pretty well-known names.
Look, there's probably three. There's three interesting ones. We've partnered with Energizer, renewable energy. So that's Energizer, the AA, AAA, manufacturer that are partnered with us to roll out solar products, around the world. That's a big untapped opportunity, the energy transition that we're still working through. I really like school camps for kids. I think we're into mental health, and one of our big strategies around mental health is getting kids outdoors.
Yeah.
And so we acquired some great assets in New South Wales that are doing really well, and we're coming down to Victoria now so we'll own hopefully a portfolio of maybe 8 or 10 sites, up the east coast of Australia, which we're partnered with Moles Australia on. And probably the third one I'd say is really interesting coming in the operating real estate is owning surf parks. Which not only here in Australia, but people are interested around the world. Again, it's a new asset. Again, it can provide, once they're operating, they've got really great cash flows and good returns. So from an investor point of view, they're almost like an infrastructure, type of assets with good cash flow and leisure assets. As more and more of them getting developed, then people get more and more comfortable with them. But that's
like pickleball or something next.
Well, could be. Well, no, true. And sport. Actually, fourth one is sport investments. That's getting higher on the radar. Like if you look at a golf driving range, you can make 50% EBITDA margins out of that. Now, you wouldn't know that, but that's people just coming for a swing, hit some balls, and have a drink and an eat, and you make good money out of it, and your overheads are low. So there's just people doing some basic but really interesting stuff that you just don't hear about, and all you hear about as a investor is BHP, Rio, Apple, which is all great to have part of your portfolio. But there's just this world that exists that the more we make it aware and educate people about it, I think it'll become more accessible and more liquidity, will come into the market, if you want to get out.
And you take direct investments on? Is it wholesale?
Wholesale only. But yes, we're developing a technology platform this year that allow people to, access different investments as well as, have their assets managed on their behalf. So it's you can see everything moving, better technology, better accessibility, more transparency, more deals. That's why it makes, I see a world long term that there's a private asset marketplace.
Yeah.
That's dwarfing, the listed market, I reckon, at some point.
Yeah, I kind of hope for it and then don't hope for it at the same time, because you just get volatility in that too.
True point, yes.
We always try and wrap up with one thing you suggest listeners go and do today. Maybe it's about their portfolio, their alternatives. Is there anything you suggest everyone go and look at, think about? I've put your website in the show notes, so you don't have to say that part, but...
No, I think it's just as a general, comment. I think you should, in times like this, one, just remain, patient. Two, I think it's just as much as what you should own. I think it's important to understand what you shouldn't be owning, and if you've got stuff in your portfolio that you shouldn't be owning, and switch it into something else, a good time to do that, right? If you've just got it wrong, sometimes you just got to take it and move on. So I think in times like that, and I think you take the time just to learn more about private assets. It's not a scary world, and just understand it better before you do it, because reading the headlines is just not good enough, because I just think they don't tell the right story or the right position. And I think it's sort of far from the truth, to be honest.
Yeah, fantastic. Perfect time to wrap up. So, yeah, definitely an interesting and engaging conversation. So, thanks for joining me, Christian.
Thanks, Drew. We'll chat soon, mate. Thank you.
For all those listening home, please send through any questions. We'll put details around Fincap in the show notes. And, obviously we appreciate the Q&A that comes through. So, thanks for listening.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.